This episode is all about the financials on a multifamily complex we recently put under contract in Albuquerque, New Mexico. Welcome to Seeking Unemployment, a show dedicated to the most efficient path to financial freedom. 44 unit down here in Albuquerque, New Mexico. And we're just going to go through all the details of this deal with Tate. He's going to kind of run us through what made this exciting. Why here? Why now? Maybe a little bit of a rundown of the overall market of Albuquerque and its growth. Why is this property exciting to you?
Sure.
I'm so curious about this.
Sure. Well, maybe I'll just start with kind of describing where this property came from and why we liked it and like it still very much.
Yeah.
We really handpicked Albuquerque as a market that we wanted to pursue strongly because of a number of things. Mainly, job diversification is excellent here. The driving economic factor in industry is the nuclear industry. Actually, there's more PhDs here per capita than anywhere else in the country because all the laboratories and whatnot. It's a city that is still very, very affordable. It's in the West, which is highly desirable. It's a great climate. Physical climate, it's a great job climate, and the rent growth in terms of the multifamily sector, the rent growth is third in the country right now, just behind Phoenix and Vegas. So Albuquerque is literally almost 6% a year in rent growth. So we feel like it's a great wave. It's a really good tailwind to get behind.
So 6% a year rent increase.
Yeah.
What is the average in the United States right now?
To be honest with you, I think it's like 2 to 2.5.
Yeah.
And that's actually
You guys
pretty
hear that?
good.
2 to 2.5 versus 6.
Right.
So
Right.
that is a really, really good reason why you'd be fired up and excited about coming to Albuquerque.
Yeah.
This makes so much sense.
Right.
Yeah.
Yeah. So, and that's just one of many factors. There's skiing here, basically 45 minutes away. There's Santa Fe is less than an hour away, which is a wonderful place. We really, like I say, we handpicked this market and we established some really great broker relationships here. And we had this particular broker, his name's Todd Clark, and so he brought us this deal, this 44 unit.
So what makes something, when you see one deal versus another, you're comparing these things, what makes you really like one deal and really just kind of say, maybe not for me on another one?
It's really numbers.
Yeah.
It really, of course there's other factors, but the numbers are first. You can't make a bad deal good, as far numerically speaking.
Lipstick on a pig with numbers doesn't work.
We've tried to turn those deals on paper from bad deals into good deals, and it's just a futile thing. A deal is either good and it pencils well, or it's not, and you should, in multifamily, be able to underwrite that pretty closely, because of the fact that multifamily is valuated at a very scientific level based on its income and its market capitalization rate, which is what investors are willing to pay in each market.
I like you said that we tried to make a deal look good when it wasn't on paper.
At the end of the day, you're looking for deals. And one of the things that we've learned to do, we looked at 85 deals, I think, before we found this one. And we underwrote maybe a quarter of those, maybe 20% of those.
Okay.
And you're asking, how do we get to that point? I think was kind of your question. What do you like in a deal, right?
Really, my question is, when a deal crosses your table that looks good, how does that stand out from the crowd?
We basically look at something that's called a cap rate, a capitalization rate, which tells us how much income is being produced versus the acquisition price of the property that is being asked, right? And anything that pencils above a certain rate, which happens to be about a 7 or so, will typically pencil well as it exists right now in its current financials and at current rent levels.
So as it exists right now would be compared to if you were to do improvements on the property. That's
right.
What you're referring to, right?
That's right.
Perfect.
So we like a deal that has really good existing financials, good existing rent roll, good existing occupancy, and has the opportunity to raise rents and produce a higher equity level based on a higher income level.
Cool. So give you lots of flexibility as well.
Yeah.
And that flexibility in my mind equals power, because you have power and control over how the asset can perform to some degree. As things in the world shift, you can pivot and you have somewhere to go, as opposed to being backed up against a wall.
Yeah, excellent way of putting it. Yeah.
Cool.
Yeah.
That's pretty neat. So let's talk about some of the numbers on this deal.
Sure. We're under contract to purchase this for $2 million, which is about $43,000 a unit. We have budgeted about $440,000, about $10,000 a unit to go into each unit.
For improvements?
For improvements.
Cool.
And that includes exterior and interior improvements. So, so that capital expenditure is part of our capital raise that we're doing. We have an aggressive plan to come in here and raise rents and raise the standard of and the physical quality of the property, especially on the exterior, but on the interior, we'll do complete remodels as the units turn over. And we're going to try to make that happen as quickly as possible so that we can get rents up about 14% from where they are now, possibly as high as 20. But we're underwriting 14. So we should be able to, what they call stabilize this property at within about a year. Therefore, we'll be raising the overall income of the entire property.
Great.
So it affords us and our investors an opportunity to create both passive cash flow through the course of this investment, which is it's nice. It's a nice level of cash flow, and have a very nice end game. Usually, probably 3 to 5 years is what we're talking about as far as an exit strategy, whether we refinance it and keep it or sell it.
Cool.
Yeah,
that's great. So if I'm an investor and I'm considering being a part of this project, this property, what kind of rates of return would I expect?
We have a minimum investment level of $50,000, and we are paying a 6% preferred return throughout the course of the investment. Then we offer a 6% back-end return over the course of that 5 years, the accumulated 6%.
Somebody that just knows stock market returns, you know, I know what a 6% return is for a stock portfolio.
Yep.
But for a multifamily or real estate investment, 6% and then 6%. When do the investors basically get their money back? How does that work? So are they getting paid first month?
Our investors get paid quarterly. On this particular investment, we are going to be paying from day one, approximately 3 months or so after their initial investment level, their initial investment. They'll be receiving a dividend check for 6%. And that'll be coming mailbox money. You're just collecting it. And
so if I'm getting this correctly, this sounds to me like the most ideal kind of situation for somebody that wants to get into real estate investing. I can't think of a better way to do it than through multifamily, because you don't have to go find a deal. You don't have to spend lots of time and energy to go find all of that stuff. You can just go join up with a team and be a part of their deal. Right. And you can keep, you know, if you're a doctor, for example, you can keep going with your practice. You don't have to stop what you're doing and spend months and months trying to find a deal and put something together and assemble a team and all of that stuff. So becomes pretty attractive at that point.
Yeah, it gives investors a passive way of taking advantage of the relative lack of volatility of the multifamily asset, commercial asset, versus the stock market, which we're seeing this week. Is you know, as of this recording, the stock market has done some unbelievable things in the last 5 to 7 business days, and so it's incredibly volatile right now. And yet the multifamily market is super even because rents are super even, right? So the values are super even. So people aren't seeing value and equity just crash before their eyes because they've got an asset-backed security, essentially.
Sure.
That's producing profit.
We made our way inside of one of the units here at the patios. We're joined here with Sean. Sean here flew all the way out from Boston to come and take a look at the property, walk it with us. And I was really curious to find out what assumptions that you made in the underwriting process, so that we kind of get a feel for how this is all put together. So,
Sure.
so how did that come together?
So one of your biggest assumptions is how much you can get rents, gross potential rents, from where they are now to where they can be. Where can that be? That delta right there is a massively important factor. And you determine that by looking at your rental comps, the comparable properties nearby, what they're renting for, what kind of condition they're in, and what kind of condition you're in, and what kind of money you might need to spend to get it up to that condition, and where you may be able to get it to. In this case, we're going from an average of $584 a month in rent. That includes everything, utilities and cable TV, even parking, etc. And we're taking that level to $750. So I believe last time I did that equation, I think it was about 14%. I might be low on that off the top of my head, but nonetheless, it's quite an increase. You're talking about $160 some odd dollar a month increase per unit. So that's a huge assumption, right? That we can get it from there to there. The biggest way that we've substantiated that is through our property manager, who knows this property very well and knows this neighborhood like the back of his hand. So he's able to say, yeah, I think we can do this. So yeah, vacancy is another one, or occupancy rate. Vacancy is obviously the opposite of occupancy. Right now, this property is running very nicely at about a 5% vacancy rate, and it has been running nicely at that rate. However, when we turn the property over and we're not renewing leases, for instance, and having people move out and be out of the property for maybe a month while we turn the unit over, we may have a little higher vacancy. So that's an assumption that we've made, is we're actually doubling the vacancy rate during the first year because of the turnover potential.
You've talked a little bit about improvements that you want to make. What improvements were you thinking of making here in the kitchen?
It's perfect. We're going to go with it as it is. No, just kidding. Just kidding. We will, at the very least, we'll put new doors on these cabinet boxes, which really does make the place look brand new with hardware, especially when we do new countertops, which we will do. I will say those sinks I actually really like a lot. If we can salvage them, we might.
Maybe just do a new faucet or something?
Yeah, like a nice commercial stainless faucet with a pullover. Those touches, we'll do new hardware, of course. Those things that people touch, faucets, light switches, light fixtures, appliances, anything that people touch with their hand is a hugely important aspect of the apartment building or the apartment unit. So we typically try to address all of those things when we do a unit turnover. So yeah, here we'll likely do solid surface countertops because the little bit more, or maybe the 20% more that you need to put into them versus Formica is just a wow factor.
Oh yeah.
It gives
people excited.
Gives the whole unit like a centerpiece almost.
Mm-hmm. Sean, you came in here from Boston.
Correct.
That's a long way.
It's a long way.
Way to make the journey.
Thank you.
No coronavirus yet, as we know.
Yet.
Yeah.
Hopefully not.
And talk to me a little bit about your role with this property and Greenlight and what you're doing.
So I'm kind of heading investor relations amongst some other things, and I feel it's very important to actually come out and view the property before I'm talking to investors. I don't feel, I would say, comfortable talking to investors without actually setting foot on the property. But yeah, we just briefly spoke about the kitchen. It definitely has what we're looking for, which is value add. When we're looking at deals, we want there to be value to be created through and create forced appreciation. We're not looking for something that's class A that's already been done. So this is perfect. And one thing we really like about this is, which I'm sure you'll show shots of, that each unit has private patios. And in a place like Albuquerque where there's over 300 days of sunlight, that's a very nice feature to have your own outdoor space. And in this area, it's the only place that offers that. So that's one thing we love. We're going to spruce that up, spruce the interiors and also the exteriors, because when we want people coming home, we want them to be proud of where they live, both from an interior perspective and exterior. So
yeah,
and this property allows us to do that. So
great. And Tate, you were mentioning something about the community as we drove up too, across the street. What's going on over there?
Yeah, so there's a huge vacant lot. It's an 8-acre lot that already has the funding, the bond money in place for a new safety station, which will be a fire station, fire and police station, directly across the street. And there's either going to be soccer fields or some other open space.
Most investors want to know, how are they going to get their money back?
6% over a year, which is paid out quarterly.
Cool.
And then, as you said, on the back end, it's another 6% per year that's paid in one lump sum. So to put it in dollar figures, if you invested $100,000, you're going to get $6,000 per year for traditionally our hold period's 5 years. So for 5 years, so that's $30,000 you've made over 5 years that's paid out quarterly. And on the back end, when we go to sell or refinance, you're going to get additional 6% per year, which you're going to get a lump sum of $30,000. So you're looking at $100,000 you put in, $30,000 over 5 years, $30,000 on the back end, so $60,000 out of 100. It's pretty great return.
It's pretty insane, yeah.
12% return, and it's.
Are you guys fired up about that? That's
I'm
insane.
fired up about
I mean,
it.
holy cow!
Well,
that's crazy.
Especially what's going on in the market right now. I think this is something that we should be shouting from the mountaintops over here.
Yeah.
It's the lack of volatility. That's what's key right now, and what we're seeing in the stock market and just about everything else is volatility, right? With the reason to me why this is so exciting, that 12% return is amazing, and it's asset backed. It's got a profitable asset supporting that and securing that investment. So you ask about mitigating risk. Buying the right deal is all the risk mitigation. It really is. As far as there's many other things: proper due diligence, hiring the right property manager, running the right numbers as you get closer to closing, et cetera, et cetera. But that initial underwriting, like we were talking about earlier, when you go under contract, is so key to the entire deal. And doing that in a conservative way with conservative assumptions is how we mitigate risk.
Very good.
I could put it another way too. Like you just said, are we fired up? Yeah, I'm fired up.
Yeah.
Imagine you just retired the beginning of 2020. Now we're into March and the market crashed more than it's crashed since 2008. You have no more of that stable income coming from your W-2 job. You're retired. There's probably a lot of fearful people out there thinking, should I go back? Do I need to get another job? Whether the storm, why the market corrects? Well, what if you were investing in a property that paid you 12% annualized for 5 years? I don't think you'd be as nervous. You know that mailbox money is coming. Mm-hmm. Whether the market crashes, most likely or not, that's not going to affect if someone's going to pay rent. The rent is one of the last things they're going to cut because they need a place to sleep at the end of the day.
Well, and another risk mitigating factor is we're buying Class C assets, which there's always a demand for, and there's especially a demand for in recessions. People who live in Class C assets aren't invested in the stock market typically. Those people have jobs, hourly jobs. Hopefully their jobs aren't affected by a recession. They may be, but ideally, especially in a Class C asset class, when people are going to be downgrading from Class A and Class B into a less expensive living budget, you're just going to end up with assets that are inherently mitigated by risk just by virtue of what they are.
It's kind of like the trickle-down effect.
Mm-hmm.
And when a market, retreats kind of like it is now, or like it did in 2008, Class A properties are going to hit first, like Tate's saying, because those are the luxury with higher rents. And, that's one of the first things you probably would look to cut back on. I'm not saying you're going to go from living to homeless, but you're going to look at, well, maybe I don't need to live in that luxury building. Mm-hmm. And so then, like Tate says, us investing in C and B class properties, we benefit from that because those people are moving down the spectrum.
Sure. And let's talk about taxes for just a minute.
Yeah.
So for an investor that might be wanting to buy into this property, Are they going to see any kind of tax benefit from having their money with this, or is that not included? Is that not part of it?
That's definitely part of it. We share, traditionally, we share 50% of the depreciation with our investors. So that means you invest $100,000. Last year we saw on average you got about $40,000 in depreciation back. That's huge to offset any passive income you have. I know I speak with investors all the time that's one of the main reasons they want to invest in this asset class is for the depreciation. Yeah, the 12% is phenomenal, but that depreciation they can offset their tax burden with. And I guess
because stock market doesn't do that.
No, not at all.
No, in fact, you get hit with capital gains taxes on top of it.
Right.
So
if you're investing in something like a mutual fund, yeah, you're going to hit on capital gains taxes, but you're actually not getting any of the money. When they pay, the way that they're structured, I'm not going to get too technical, but when they pay a capital gain, you don't see that money, but you're getting taxed on it.
Yeah, so it's a little extra sneaky, right?
Yeah.
Yeah. Very cool. Do you guys have anything else you want to add?
I just want to use the word recession resistant.
Cool.
That's 2 words. Recession resistance. And that's only because recession proof is, I think, a little too bold of a claim.
Yeah, you can't.
I think recession resistant might be a little bold of a claim too. But when you think about what we were touching on about the compression into the Class B and C assets, that produces a supply and demand factor that does mitigate the recession aspect of what might happen to your investment. When your investment is in high demand, even in a recession, it's going to support the value. So that's what we love about this, as well as tax benefits and the leverageability and the forced appreciation and the wealth growth and the passive cash flow. There's so many aspects of this that are so exciting. Yeah. And risk mitigation to me is a big one. It's a huge one.
To back that up with numbers, if you look at the 2008 recession, the market was down over 32%, while multifamily, the asset class, was down only 6%. And the reason for the 6%, it could have even been less than that, is because of what was happening in the mortgage industry, where people were over leveraging. They were giving out like 100%, LTV, which is insane. And on top of that, people were taking short-term debt and having variable debt. And what happened was, because they were getting better rates, that's why they're doing this. And what happened was, when the recession hit, unfortunately, those loans came due. So they were called by the lenders, and they couldn't refinance because what was happening in the market. The lenders were so nervous, they didn't know where the market was going. So these people lost their properties. And when we underwrite and when we take loans, we're not doing short-term or variable loans. We're doing long-term fixed loans, which is much safer.
Okay. And that also helps protect the investor.
Exactly.
From any kind of extra variability.
One thing to note too is that everything that we're talking about here about this particular investment will be disclosed in formal legal documents to the investors that are involved in this deal. So, and they will understand everything inside and out as far as the aspects of this, the risks, the way things are paid back, the questions about tax benefits and depreciation. Those questions will all get answered. So don't feel like you need to overwhelm yourself with how this is all going to work, because we'll help you understand that. And we've got all the information ready to go and are in printed form and digital form, and can provide that to anyone.
Hopefully that shows why this diamond in the rough property is so special and why we're so excited about it. To join us on our next episode, make sure you subscribe, and we'll see you then.